morning and welcome to Chart of the Day Cafe for Tuesday, August 18th, 2015. Just going to read our disclaimer quickly. Trading stocks is a high level of risk and viewers should complete their own due diligence on any stock or underlying that they intend to own. 100% of the content of this video and communique is intended for journalistic and educational purposes only. This video and all indicators, strategies, and articles herein should not be construed as investment advice. Thank you for your patience with that. So as always, we start our videos off with a 2-year weekly chart of the Russell Index. We use the Russell as our simple proxy for overall market health, strength, and direction. And because we never want to put a chart forward to our viewers unless we're putting it forward in a rising market environment. So as you can see on this 2-year weekly chart, through much of 2014, we were keeping an eye on this channel that the Russell was trading in, indicated by these blue lines. In the latter part of the year, price started to migrate to the top of the channel, and then in 2015, in February, it broke up and out and entered this new price territory that we are currently in. So we're up and out of the prior channel, but last week tested the upside of that channel line right here and bounced off and is starting to form a bullish candle this week. We've been keeping an eye on this orange line of support resistance. When price is above it, it is support. When price is below it, it is resistance. So you want to note that we're coming into that area where price will be challenged a little bit, but with the trend on the Russell, for the most part, up, and price trading sideways, our bias will be that that uptrend continue and that price start to move up and away and over this orange line. So that's the weekly chart. I will pull it away from the weekly to the daily. At Chart of the Day Cafe, our rules say that we will not put charts forward unless price on the Russell is up and over this blue line on the daily chart. So with the price action yesterday, which was very positive, it pushed price up and over that blue 8-day EMA. So we will put a chart forward today, but I do want you to note that we're coming into that orange area of resistance. The futures are off a little bit this morning. I'm filming this at about 10 after 8. But because yesterday was so positive, I would think that we would get some follow through and it start to lift up and away from this area here. So that's our look at the Russell. Let's get into our chart for today. And the chart I want to show you is a really terrific one. One that I'm sure a lot of you are very familiar with. Disney. Wow. This is the 2-year weekly chart of Disney. You can see first and foremost the beautiful, beautiful, beautiful uptrend. And then they recently announced earnings and the price on Disney was really punished. They beat on earnings, but they fell a little short on sales, and the market is in no mood for that kind of stuff, so it really sold off. But I want you to note where it landed at this very strong area of support. These are weekly candles. It spent all of these weeks at this same area before lifting up and out. Why I like Disney? A number of different reasons. It's in my wearables basket. The new toy lineup that they're coming out with, I'm going to send you an article with this video, is incredible. The wearable toys that are coming out this October. Their Star Wars franchise with the new Star Wars movie coming out later this year. Their purchase of Pixar in 2006 and the 2 Pixar movies that are coming out this year. A lot of upside catalysts for Disney. So this is the 2-year weekly chart. I'm going to pull it away from the weekly and I'm going to go to the daily chart so you can really see. At Chart of the Day Cafe, we never make recommendations. I'm just giving you the heads up on charts that I think look interesting. I'm going to indicate by my green circle an interesting area. So you can see how on that earnings day, price really fell off. But it's been defending this orange line ever since. And yesterday was a nice solid day. So with any kind of follow through, you know, at Chart of the Day Cafe, what we use as our guide is this 8-day EMA. When price moves up and over the 8-day, we're interested. Anywhere below it, we are not interested. So we're always watching that 8-day EMA. But it looks like with some follow through later today. So the morning might be soft, but hopefully we'll get some firmness in the markets in the afternoon and some lift on Disney. I think this is an interesting area to be watching this particular candidate. So with the technicals out of the way, let me tell you a little bit more about the fundamentals on Disney. It is currently trading at $109.05, but it's worth $136.49. So you know what, Chart of the Day Cafe? The thing we look for more than anything else is value, value, value. And the value score on Disney is really nice and high. So you get value in an uptrending stock that's in an uptrending sector in, for the most part, a sideways to uptrending market. So with any kind of follow through and strength, Disney looks like an interesting one to look to. It's got a forecasted earnings growth rate of 16%, a PE of 19.83, and it pays it's got a 1.21% dividend yield. So nice dividend. So you get growth, value, and a dividend. Three great things. You know, once we have the fundamentals out of the way, what I try to do is highlight some interesting things. Disney has come out with so many great announcements. Yesterday, they announced their plans to build 2 new Star Wars theme parks. If you go to Yahoo Finance, you'll see all sorts of news about it. That's a huge catalyst going forward. I did a screenshot of their movie lineup for 2015. So they've got Ant-Man in the theaters currently. They've got The Jungle Book coming out. This is a Pixar movie. And then, of course, Star Wars later in the year. All good things for Disney. I'm going to play this little clip from Kramer and his reaction after Disney sold off a few weeks ago. So that is my Chart of the Day Cafe for today, Tuesday, August 18th. For those of you that want to stick around and listen to the video, great. For the rest, I will be putting another video out, hopefully, on Thursday. Thanks, guys. Have a good day.
Is this the end of the world for the media stocks? No, but it's certainly the end of some of the higher valuations. However, I will say up front that Disney, which is the proximate cause of the sector-wide decline, remains the best integrated media company in the universe. And I reiterate that when it comes to Disney, this weakness is indeed a buying opportunity. In fact, many may look back at that 104 intraday low price the stock hit today. It went out at 108.55 cents, and kick themselves for not pulling the trigger. 18 points down from where it was just 48 hours ago. The whole group in free fall. Why buy Disney above the rest? Because the programming at almost all the other cable companies is dominated by content which can be streamed, which means their channels can be dropped easily from your bundle. You can watch anything from Viacom at a later date. There's no immediacy, which is why that stock's been hardest hit, down 13%. But you can't stream ESPN. Sports have no shelf life. And that's Disney's bread and butter cable. So why then does Disney continue to go down for its simple acknowledgement that it has some cable subscriber losses? Because of the mechanics of the stock market, not the mechanics of Disney. Stocks that have gigantic declines on day one, as I tried to teach you, and that's what Disney had, tend to get hammered again on day two. Big institutions that were selling yesterday down 10 didn't finish cleaning house yet. I know it seems absurd to those who own a few hundred shares of Disney and can come and go from the stock as they please, but a big institution often needs help trying to find buyers for its stock. Yes, the positions can be that massive, and it's obvious that the brokers who were hunting for buyers yesterday couldn't find enough of them to take out the freaking sellers. They're selling a stock that they didn't finish selling yesterday. Barring catastrophe in the market tomorrow, I think the sellers will be done. And Disney's huge buyback will mop up what's left. My old buy on day 3 rule. Why are these institutions selling it even down here? Because the managers selling no longer believe that Disney is a growth stock. They just went out. They just went out of it. Every share, no matter what price. I think that's just plain dumb. But I want you to put yourself into the seller's head so you can see what they see. They know Disney's stock is undergoing what's known as a re-rating, meaning that Disney and the rest of the media group simply aren't worth as much as they used to be because they have much less growth than these portfolio managers thought. There's no denying that if Disney can't grow its subscribers, it either has to cut prices to bring in more, something that we loathe to do, or it has to diversify away from cable because ESPN won't make them as much money. And remember, ESPN and cable, 50% earnings. The issue I have with the sellers is that it's not like Disney CEO Bob Iger doesn't see this, doesn't know it. Come on, he spent a huge amount of time and money building up the movie studio tent poles and the theme parks. With Star Wars on the horizon and Shanghai Disney's 2016 business, companies in much better shape than, say, Discovery, 21st Century Fox, Viacom, Time Warner, all of which depend far more on cable subscriber growth, and for the most part have easily streamed content so they can lose subscribers far more quickly than Disney's ESPN will. Once the smoke clears and the big sellers get finished, and they do get finished, I think Disney will be in there buying back stock hand over fist. You should be in there with them. As I told you yesterday, if you just take a super short-term perspective, you're looking at Disney all wrong. Here's the bottom line. You need to evaluate it long-term as a company with tremendous franchises, all of which are being ignored right now because of this one line item, cable subscribers. It was wrong to buy Disney at 122. Okay. Down here, I think you can pick up some. Knowing the company's diversifying away from cable faster than any other media outfit, and I believe Disney will succeed in doing so by this time next year. Patience, please, if you buy. Remember, though, with the stock of Walt Disney, patience has always been rewarded. Gabe in Nevada, Gabe.
Hey, Jim.